Yes, okay. Start the recording. Okay. Yeah, it started now. All right. So let's continue from where we left off the previous day. As we were discussing the DP solution 7 as part of our work on a simple trading system. We should launch that page as well. Simple trading system discussion, which is going to be only addressing initially as a very very minimalistic trading system, addressing only these three additional decision problems with this light orange background: buy, sell, exit with loss, and position size, in addition to the first three, which you always have to decide. So as part of this scheme, we have eventually come down to the discussion of number 7, position size, which we had initially done in a very ad hoc kind of manner with which you saw here on your session board, which we had done here as I told you to do this in a trial and error method, but now we're going to do it in an algebraic way. And so that's what we were doing. We have done as part of this trading system buy, sell, position size, all right? And then we had gone to DP7, where this is what we had discussed the previous time. This is actually a topic, so put it in board. Right, okay, so we have done this point and we had discussed the various functions. What is the function of what? And you can see that we discussed all this. We discussed this conservative approach to risk planning. Okay, so there was a point where we had mentioned this aspect of, I'm trying to figure out where we wrote that actually. We had discussed this point about PNL is only PNL is always calculated in the terms asset, in the terms currency, in currency markets, and in the terms asset. Okay, so let me just find out where we had written that actually. This is a later discussion. This we have already discussed. We can leave for later in this particular discussion. Anyway, so if we can't find that, we'll just rewrite it again. I'll just rewrite that once again. I'll just copy. Okay. So this is an important part which we are going to now figure out. Okay, how to algebraic derivation of this position size. Okay, from this formula. So algebraic derivation of position size. Let's write that as a way of. So the important thing here to understand is position size or number of units. Okay, we'll just call it position size. This is the basic. This is a general term that you can use in all asset classes. So this is our the point that we are trying to establish now and see how it is done. Okay, so in this, so the important point to understand here is that what is new that you're learning here compared to what you will see in industry. In industry, a lot of people tend to, even professional traders on bank trading desks, etc., they tend to think of the position size kind of independently. Like they make up their mind, they form a view, and then they just decide, okay, I'm going to buy $10 million or I'm going to buy 10 million euros against the yen, etc. So the position size, they tend to just think of almost as an ad hoc, exogenous kind of input, okay, but as an independent kind of input. But the important thing that I'm teaching you here is that position size should not be treated as an independent input. It actually comes as a dependent variable based on various other aspects of your calculation, like this whole calculation we discussed, okay, which gives you your risk capital, total risk capital, and then total number of losing trades gives you the maximum risk per trade. And the point I'm trying to emphasize here is this, that the That position size should not be treated as an independent variable. It's actually a dependent variable as a function of these other variables. Okay, that's an important point, because this is one important way for you to control your risk. And risk control is everything. In this business, risk control is everything. It is the key to survival. It is just keeping a tight control on things that you can actually, control. So therefore, this is important. So therefore, algebraic derivation of position size. The first principle we always want to talk about is that P&L is always generated in the terms asset. If you ever forget this, okay, let's write it here. If you ever forget this, it's very easy to figure it out. Remember, you must know what the terms asset and base asset, this terminology, you must understand very well. Okay, so you can check your notes and understand that. Like here, in the dollar Canada, the terms asset is Canadian dollars. Okay, so it is the reason you say that is you have to understand. This is the understanding of convention, of course, that if you write USD CAD, generally the base asset is written first. And also you have to understand from the market convention to figure out basically what is the one that is remaining invariant on any chart of a market price. It is here what is happening is you see the scale runs from about 1.46, 1.4648 to about 1.28. This scale, what does this mean? This variation is actually the number of Canadian dollars required to buy $1 US. Okay, so we'll call it CAD and USD. So number of CAD required to buy $1 USD, but the $1 USD part is not changing. Okay, it's always the price of $1 USD, but how many CAD you need to buy $1 USD, that is changing as the market supply and demand, creates shifts in the price. So that's basically it. So here, that's why the Canadian dollar is the terms asset, because the US dollar, 1 unit of the US dollar is being priced in terms of Canadian dollars, and the price is moving around. Okay, so therefore, what you have to understand is when you do any kind of, let's say if we do if I go short, let's say Canadian dollars, here this will be our input cell. This is already in your, these are our input cells, okay? And these are actually also our input cells, entry, exit. Actually, I don't know why I put this in bold. These are also input cells, but here if we take in $1 million and if I enter, okay, if I enter at 1.34 where the market is today, let's say if I go short and then I have a stop at 1.38, okay, or 1.37, so 1.34 and 1.3750, let's say, right? If I enter $1 million at these, at this, let's make it 4 decimals. Right. So this is basically what happens. That the point I'm trying to illustrate here is that we'll see the calculation of this later on. But the point I'm trying to illustrate here, terms asset, P&L is always in the terms asset. So in any market, when you're calculating P&L as part of your general steps, what you have to understand first is, in this market, what is the base asset and what is the terms asset? This will be true in every market. You can figure it out. I'll give you some other examples from different asset classes and markets. Let's just quickly run through this exercise. Let's take Euro, US dollar. So interesting. Notice that these are the conventions in the global foreign exchange markets. So when you trade euros against US dollars, in this case, the euro is the base asset. Okay, this is just a convention. Okay. But the market has to follow a convention so that things can be done quickly. And we don't have to discuss all these points every time somebody comes to trade. So the euro is the base asset in everything involving the euro. Okay, the euro is the base asset. So even when you're trading, this will be written as EUR USD. If you see certain terminology here, you'll see that some of these guys like Coanda, etc., they write it as like this. This is the way it's written. EUR /USD. This is how the currencies are normally written. Okay, so EUR USD, and even if you go for sterling, okay, it will also be written as EUR GBP, which means again this is number of British pounds required to buy €1. That's how it's quoted. Okay, so a couple of examples from currencies. Aussie is also another currency where even when it's trading against the US dollar, as you can see here, Aussie is the base currency and US dollar is the terms currency. Okay, so in the currency market, you can say currency, and we borrowed that term and used it for as a general expression for all asset classes, and we have used the term base asset and terms asset. So here in general terms, the Aussie is the base asset, the US dollar is the terms asset. Now what about stocks? When you're trading Freeport McMoran, okay, when you're trading Freeport McMoran, let's take a test here. Since Ketan is not on mute, let's ask Ketan. Ketan, what is the terms asset in Freeport McMoran, FCX? Yes? Ketan has gone to sleep. Okay, let's ask Priya. Priya, you're following the discussion. What is the terms asset in FCX? What happened? Everyone is silent. Am I audible?
Yes, sir, you are audible.
Okay, fine, good. That's reassuring. So we have two people sleeping. Let's find out who else is sleeping. Okay, let's ask Piyush. Yes, Piyush, can you hear me? Piyush is also sleeping. Saturday, everybody's sleeping. Okay. What about radio jockey? Rajat?
Yes, sir.
Yeah, okay. You heard my question.
Yes, sir. I heard your question, but don't know the answer, sir.
You don't know the answer? The question is terms asset. But what is the terms asset in this FCX? When you're trading FCX, what is the terms asset? No idea.
No, sir.
Okay. Let's ask Ritika. Ritika, can you help us with the answer?
Yes. Sir, are you asking me?
You heard the question, right? What is the terms asset when you're trading FCX? You're trading FCX in a market, right? You're trading you're trading it in the market for FCX common stock. So there have to be, because of the way we define a market is, we said the market is a venue for exchanging two assets against one another, and one of those is usually a currency of some sort. And so the general definition is two assets, and then we said in practical terms, in most markets, one of those assets is going to be a currency since we're not doing barter. So yes, Sachin. Yes, what is the answer, Sachin? So Kritika is also passing. Okay. Yes, Sachin.
I think for FCX, there's shares.
Okay.
Sir, I am paying the money and I'm getting the share. So
No,
one asset is
money. My question is very specific. My question is, when you're trading shares of FCX in that market, okay, this is the market for FCX shares. This is how you understand. When you're trading GE, that is the market for GE shares. Okay, when you're trading Duke Energy, that's the market for Duke Energy shares. So in the market for FCX shares, what is the terms asset? I have to explain these terms to you. These are all available in your notes. I've asked you to read them. What is the terms asset? Use the logic that I gave you. The base asset remains fixed. The base asset remains fixed, and the base asset remains fixed. Okay, Siddharth has given the answer. I think Siddharth has already given the answer, but anyway, so yeah, it's okay. So let's save some time. So in this case, the answer is that it's US dollars, obviously, because when you trade FCX, what is happening here? The way to figure it out is always to look at the chart and to figure out, you know, that there are two assets in any market, okay? and so one of the assets remains fixed, and the other in sense that when you look at the chart, when you look at the chart and the chart is moving up and down, okay, so obviously there's some variation happening, but one of the assets is remaining fixed, and one unit of that asset is being constantly repriced and repriced in terms of the other asset. Here, what is happening? When you see all these values 4 all the way down to say 18, what is all this? It's not like you have 6 shares of FCX, 10 shares of FCX, 16 shares of FCX. No, it's always 1 share of FCX. What is happening? What is this variation documenting? The variation is documenting the number of dollars required to buy 1 share of FCX. That 1 share of FCX business is always remaining the same. Is this clear, Sachin?
Yes, sir.
Okay.
Yes, sir.
Okay, so everybody else, I hope it's all clear to all of you now. Rajat, is it clear now? Yes, Rajat? Okay, so the point is here that this is the logic that you have to use. Don't try to memorize stuff. Understand this from a logical perspective. In this case, because you're exchanging these shares against US dollars, you're trading in US equity markets, these will be US dollars. If you go to, let's take instead of taking the Japanese stocks on the Tokyo Stock Exchange, they have these funny tickers, they have numbers. Okay, harder to remember. Okay, now let's ask, who do we ask? Let's ask Harsh. Toyota Motor stock trading on the Tokyo Stock Exchange. What is the terms asset?
Sir, can you repeat?
Now you can see the chart, Toyota Motor chart, trading on
Yes,
the
sir.
TSE, Tokyo Stock Exchange.
Yes, sir.
You can see the chart, you can see the right-hand scale, okay? What is the terms asset? In this market, this is now what you're watching is the fluctuations in the market for Toyota Motor stock, common stock of Toyota Motor. Okay, this is the market. This is a distinct market from market for FCX shares or Microsoft shares. This is a different market. Now in this market, every market is going to have a base asset and a terms asset. So what is the terms asset in this market? Actually, the answer is on the screen. If you can see it, the answer is on the screen. I have told you the logic to figure out what is the y-axis.
Sir, JPY, Japanese
Correct.
dollar.
JPY is the terms asset here, okay? Because what are you doing on the Tokyo Stock Exchange? Yes, Sachin? Yes, Sachin?
No, sir, nothing, sir. I'm answering the question.
Okay, okay, all right. So basically this, you can see here, look at the terms, look at the right-hand scale, all this variation that is happening, what does it represent? Is always 1 share of Toyota Motor Corporation, and the right-hand scale is showing you the variations in the number of Japanese yen required to buy 1 share of Toyota Motor. Okay, same thing if you want to ride a different car. Okay, now let's ask Saloni. What is the terms asset? Maruti Suzuki trading on the NSE. Yes, Saloni. I'll come to you, Sachin. Yeah. Saloni is also sleeping. I think Saturday a lot of people are sleeping. Okay, let's see who else is sleeping. Okay, let's ask Sachin. Sachin, what is the answer?
Indian rupee.
Indian rupees. Correct.
INR.
Okay, so INR is the terms asset because now you are trading it against Indian rupees, guys. So you have a sense of it now. Those of you who are sleeping can listen to the video later and figure it out because we don't have time to do all this by. I try to write so that I have everything in your notes itself, but generally I think you have to watch the videos as well because it's not possible to write everything and it will slow me down. If I can just explain it with charts on the video, then I can cover more material. Okay, So now you've understood what the terms asset is. This is the way to figure it out. Don't try to memorize anything. Look at the chart, okay? Look at the chart and then see think about what does the right-hand scale represent. Copper is an internationally traded commodity, okay? So, and also remember these basic definitions. Every market is a venue for exchanging assets, two assets against one another, and in effective practical terms in the modern world, most of those markets, one of the assets is going to be some currency, okay? Because we don't really have barter today. So one of these assets has going to be a currency. And so that's pretty easy to figure out. Then all you have to do is figure out which is the terms asset. Okay, so generally, when you are not dealing with currency markets, the terms asset is generally some currency. Okay, as you saw in the case of Maruti and Toyota Motor and FCX. But when you're dealing with currency markets, you have to be a little more careful because both of them are currencies. So you have to be careful about which is the terms asset. All right. Okay. So in this case, copper, internationally traded commodity. Anybody wants to try? Krish, what is the terms asset?
The US dollar, perhaps.
Dollars. Very good. So Harsh has answered US dollars because a general rule in internationally traded commodities, there are some other exceptions like there's a British pound contract for cocoa on the which trades in London. But generally, all international commodities, terms asset will be US dollar. Oil, US dollar. Copper, US dollar. Okay, so this is how it works. So this is base asset, terms asset. We are discussing very basic stuff here. Okay, so we have to just move the chat box up to right. Okay, so this is where we are. All right, we are actually trying to do something. So what we are trying to establish. Yes.
Sir, what if the foreign investors were investing in Indian equities? So, sir, for them, would that terms asset would be INR or USD?
No, it is still INR for them. What they're doing is they're actually doing. Let's say if they look at say if they're investing in SBI. Okay, so where is SBI and State Bank of India, BSE. So terms asset is still Indian rupees because the direct market in which they are playing is actually the market in which the two assets are common stock of SBI and Indian rupees. Okay, base asset, common stock of SBI, terms asset, Indian rupees. What is happening for these guys is they're taking, let's say, $1 million portfolio. They're coming from the US. And they are selling those $1 million to a bank in India. Let's say they call up HDFC and they want to do a foreign exchange deal. They sell $1 million to US. So they do one deal in the other market for currencies. They go to the dollar rupee market. They sell their $1 million of investable capital to HDFC Bank, and HDFC Bank sells them Indian rupees. So they do one deal where the markets are US dollars and Indian rupees. And then they convert that $1 million into, say, 76 million rupees. All right. And then they take that 76 million rupees and they open a brokerage account in India. And that becomes their investable capital in the Indian brokerage account. So with that 76 million rupees, then they start doing trades. When they do a particular trade in the SBI market for SBI shares, the effective terms asset is still Indian rupees. Is this clear, Siddharth?
Yes, sir.
Okay. All right. So now you have a good idea about all this very basic stuff. So the important principle to remember, because I'm always trying to teach you general principles, okay, and logical reasoning, so that you don't have to memorize much. You just can figure out everything from these general principles. PNL is always generated in terms of, if you ever forget, okay, just remember the example, let's say, of sugar trading. Imagine that you're a sugar trader in India, okay? You trade, let's say the wholesale trade is in quintals. You trade, say, in a given day, you do a traded volume, in a given day, you do traded volume of, let's say, 300 quintals. And you're buying the 300 quintals that you buy. Let's just put it here, okay? And your average buying price, it's say 140 rupees. This is actually in percentages, we'll change it. And then your average selling price is 175 rupees, okay? So we'll just, okay, and this is 175, okay? So your profit per, your average profit per unit is exit price 175 minus entry price. This into, we have to now, this is your average, and then your total profit is times volume traded. Okay, that is 300 quintals. That's your profit. Okay, so if you ever forget, what you have to do is just work through mentally in your own head. If you ever forget this principle, that P&L is always generated in the terms asset is an important principle. And if you ever forget, work it backwards. This 10,500 rupees that you earn today, what is this? This is not sugar. It's not like you earn 10,500 quintals of sugar, right? This is Indian rupees. Is this clear? Very basic stuff, but important principle to remember. And you can get confused when you start looking at currency markets and things like that. But if you keep this basic principle in mind, you will not get confused. Okay? P&L is always generated in the terms asset. So this 10,500 is actually in Indian rupees, which is the terms asset. So this is an important principle. P&L is always generated in the terms asset. And so let's look at the sugar trading example. Okay. Now let's go back to our three scenarios.
Sir,
Yeah.
sir, but in case of companies dealing internationally, they would have other currencies on their balance sheet also. Like they would have assets in other currencies too, right?
So this is what are you saying? This your point is in relation to what? Which idea?
Okay, you said about P&L. Okay, I'm talking about balance sheet. So balance sheet can have, like you said, that it has to be in terms asset, but there
Okay.
it would be different.
No. Let me not confuse P&L and trading P&L. Okay. Let's make your point is good that you asked the question. So I just used it casually as P&L because we are discussing trading. So it's trading P&L that we are talking about. Okay. So that P&L that will involve all kinds of revaluations and conversions and things like that. But their P&L, in the case that you're referring to, the context that you're referring to, in that context, there is a reporting currency. Okay, so every company will have there is a place where they're headquartered, and they will have a reporting currency. So they will report in that reporting currency. So everything has to be translated into reporting currency terms. Okay, so if you have assets, let's say if Tata Sons has some assets they own some building in the UK, then the market value of that building, obviously, when you're talking about the market for that building, the terms asset is British pounds because it's in the UK. But when Tata Sons is preparing their balance sheet, okay, they sell that building and they're reporting the gains on the P&L. When they realize the gains in England, they will be realizing in British pounds. But when they report it in India, that is going to be reported in Indian rupees, and they'll have to use a conversion rate based on the regulations given in the accounting standards, etc. But here we are talking about trading P&L. So in this context, it's a much more narrow scope because your trading is always done in a market, and any market will only have two assets. Okay. So if you're, let's say, a US investor like Fidelity Investments from Boston is running an Indian equity portfolio, they have already done what I told you. They traded with HDFC Bank, sold their dollars, bought Indian rupees, opened a rupee trading account. And in that account, now they're trading in markets in India, which are all terms asset is Indian rupees. This is clear. Later on, when they make their money and whatever profit they've made, they will buy back US dollars and do another foreign exchange deal and report that profit in US dollars. Is this clear, sir?
Yes.
Okay, all right. So we are talking about the trading context, which is always, remember, whenever you're trading in a market can only have two assets. So one of them will be the terms asset, and trading is always, and P&L is always generated with the terms asset. And so what we discovered yesterday is from all this stuff, we rewrote this stuff here, and we wrote it like this. We wanted to talk about three scenarios. Okay, so we want to talk about three scenarios here. What is scenario one is, no, we want to do scenario, this should be scenario one. Okay. So the reason we are doing currency market calculations is that these are the most complicated. So once you evolve your general principles based on currency market calculations, you can then do it for any other market. If you're trading bonds or you're trading commodities, you can do it. It's very easy. So we'll do the most complex situation, and we'll talk about modeling trade P&L, okay, which is, we'll call this scenario one, okay, which is risk capital is in US dollars, trading is in US dollars, Swiss franc, okay. So this is example that we are giving, okay. I think we went through this yesterday, which we may have used USD CAD yesterday, doesn't matter, we can use this. Okay, so let's look at this example here. Yeah. So the general example of this is very complicated sounding kind of example, explanation. So here, not written in the right place. Okay. So what we're writing is the risk capital is in USD in all scenarios. Okay. This is the example, but most of the time the US dollar is the international, the number one international currency. So we'll take a situation where all the time the risk capital in US dollars. So what we're trying to do is here, don't lose sight of the bigger problem. The bigger problem that we're trying to solve is the problem of PP7, okay, which is what we're doing here. How many units to buy, sell, and that, as we said, is not an independent variable to be just determined arbitrarily, but it is something that should be related to your maximum risk per trade, entry and exit prices. So these two are determined according to the discussions we had here, okay. Now, and this is determined according to the discussion that we laid out here in your session board, this discussion, okay. This maximum risk per trade comes out of this kind of calculation. So now that you have all this, now you have to determine your position size as a function of this, okay. So what we are going to do is we are basically going to set this maximum risk per trade equal to the trade P&L in our calculations. We can write this also, and then we look at the calculations, okay. We can write this also as a general principle, okay. Okay, because that's what we want to do here. If you remember, we have already gone through all these discussions, but we have gone through them not in an algebraic way. We have gone through them in a more of a in a trial and error kind of manner, but we have gone through these ideas. So you already know this idea that when we are talking about the trade P&L, the trade P&L has to be the entry price minus exit price in brackets times the number of position units. Okay, so once you do the number of units also, then you get the trade P&L for the entire trade. So this generally, when we look at this, we will be setting for these calculations, we are going to set it equal to the max risk per trade, which is basically what you did here also, that you looked at the max risk per trade and then you derived your position size. This is the main idea here, that position size is not something to be independently determined. Oh, I'm feeling very confident today, let me put on a big position. That's not how it should be done, okay? So it should be done as a dependent variable, dependent on all these calculations, okay? Maximum risk per trade, entry and exit prices. And so what we did essentially was, this is essentially derived by using this rule that my trade P&L, projected loss on the trade, should be equal to my maximum risk per trade. All right. So that's basically the idea. So what we are saying is, this is another important rule, that we are going to be setting the trade P&L, and because in the formula we'll be writing trade P&L. You won't be writing this, but you have to understand that this will be, when you apply the formula, you are going to be setting the max risk per trade, which you have from this kind of a calculation. And essentially here, when you from this kind of calculation here, you derive the max P&L. That max risk per trade. That is what is going to go into your. That's going to be set as the trade P&L in the formula. Okay. So that's why we'll see the formula. So what we do in the first scenario, we look at currency market calculations. Okay, so scenario one is risk capital is in US dollars, trading is in USD Swiss. Okay, we can make it what happened here? I thought I pasted something. Okay. Maybe I'm pasting it in a different place. No, okay. I thought I pasted something somewhere. Okay, maybe I didn't paste it. I just copied it, but I didn't paste it. Okay, so let's look at this. We'll make it Canada. Okay, we'll make it Canada so that it matches the text. Okay, so the risk cap is in USD. That's there in all situations. So we don't have to write this. Okay, we'll keep it. So this is a situation which we generally define like this. Okay, so notice that it can look a bit complicated in terms of English. Okay, and also maybe in terms of the algebra, because we're doing it in a very funny way, writing it in a Google Doc, writing formulas, so they look very funny, so it can get very confusing. But it's not that complicated. Actually, just keep your head clear. P&L is always in the terms asset. And what are we trying to do here? We are just trying to do a algebraic derivation of the position size. That's all we are trying to do. And so this is our basic problem. So don't lose sight of that, you'll understand. And algebraic derivation of position size, and the number one formula you have to remember is that position size is a function of these variables. Okay, so that's all we are trying to do. So don't lose sight of that, you won't get confused. We are trying to model the position size as a function of these three variables. And in this case, we are going to put the trade P&L into this. We're going to use the trade P&L as this variable, because the goal is to set the trade P&L to basically you're deriving the trade position size in such a way that the total loss, the trade P&L that you experience for that particular trade should not be greater than the maximum risk per trade. So effectively what we do is we set the trade P&L, the projected trade P&L, we set it equal to the maximum risk per trade. Any questions so far, guys? Is everybody following what I'm saying? Okay. Right, let's continue. Okay, so if you keep these things in mind, you will not get confused. Okay, that's what we are trying to do. Okay, now set trade P&L. Okay, now we're going to consider three scenarios. So the first scenario we described is you're trading in dollar Canada. So the importance of dollar, the meaning of dollar Canada, risk cap is in US dollars in all situations. Okay. All right. So In this case, the trading is in dollar Canada. So the importance of dollar Canada is, let's go back to dollar Canada. See, we'll choose the Oanda variable. Okay, so let's ask Khushbu. Dollar Canada, what is the terms asset? Yes, Khushbu? Okay, so she's also sleeping. Lots of people are sleeping today on a Saturday afternoon. Okay, so in this case, yes, we have some people who have raised their hands. Okay, let's ask Srishti. Yes,
Sir,
Srishti,
yes, sir.
what is the terms asset?
Sir, Canadian dollar.
Okay, what about Kritika? What is
The
it?
terms asset, I guess it's US dollar.
Kritika thinks it's US dollars, Srishti thinks it's Canadian dollars. What about Jakar?
So it's Canadian dollar.
Jakar is also Canadian dollars. What about double A?
Sir, Canadian dollar.
Double A is Canadian dollars. Okay, so Kritika is on her own. Everybody else thinks it's Canadian dollars. So Kritika, actually that's not correct. It has to be Canadian dollars. Remember I explained to you earlier, the logic is look at the chart and understand the market convention and figure out what is the scale represent, what is it, does it mean number of US dollars required to buy one Canadian? No. It's actually number of Canadian dollars required to buy one USD. So therefore Canadian dollars must be the terms asset because that's the one that is changing. And the base asset, base is fixed. And so the base does not change. Okay, so here's Canadian dollars. All right. So let's go back to, okay. So quickly, so we are going to do this first example of the first scenario, calculation of P&L. So what we are talking about is, we have written this in general terms. It sounds very confusing when you read it, but it's not that complicated. Just understand what, because we have to write it in general terms. The first scenario is the P&L is in a currency or asset different from the asset in which, let me put a break in here, it'll be easier to read. Asset in which risk capital amount is defined, okay, which is in our case, in the three scenarios, is all US dollars. Risk capital amount is defined always in US dollars for our discussion, okay. But the risk cap currency, we'll put a, risk cap currency is the base asset in the market traded, okay. So what are we saying? Three things. PNL is in a currency different from the base, from the risk cap currency, because PNL is in US, in Canadian dollars, in CAD, because the terms asset is CAD. So in this market, when you trade, the PNL is in CAD, okay. The PNL is in CAD, and so it's different from the risk cap currency. The risk cap currency is US dollars, okay. So PNL is a currency different from the risk cap currency. But the risk cap currency is the base asset in the market traded, which is true here. Risk cap currency is US dollars, which is the base asset in the market being traded, which is dollar Canada. Everyone clear so far? So the English looks very confusing, but that's all we're saying. First scenario, we are characterizing it like this. In this case, how do we write the trade PNL? We are just going to write PNL, okay? How do we write it? Remember, position, okay? Position, expect, so we write this is exit price, entry price, entry price, exit price. Look at the formula for a while, I'll explain. Right now, forget about this part, okay? Forget about this part, just look at the first part. The LHS and RHS, forget about the divisor that I've got. This makes sense to you? That if you forget about this part, then here is just like sugar trading. If you're trading sugar in the wholesale market in India, how much for profit did you make? Total number of units traded, position, times exit price minus entry price, okay? So I average selling price 175 rupees, average buying price 140 rupees per quintal, total number of quintals traded, say 100 quintals. Then total profit made, that is the P&L, is equal to 100 quintals into profit per quintal. Is this clear to everyone? Very simple. Okay. The only modification now will bring this back. Okay, so I've tried to use the brackets. Obviously, we should be using some kind of mathematical software here to make it look more normal, but it looks kind of abnormal because we are all used to doing it on pen and paper. But I think you can make out what I'm doing here. Okay, so the whole thing goes in one bracket here. Okay, so what you're doing in this bracket, you leave aside this one. What you're doing here, this part is, let me explain this also. Okay. You understand this? If I just take this part, this gives me the P&L in the terms asset. Because I gave you the example, number of quintals traded, entry, exit price minus entry price per quintal, average entry, exit average entry. And so this, if I just take this, that gives me the P&L in the terms asset. Okay. So far, everyone's clear? Very simple. But that's not good enough for me because I need to match. Because remember what is happening, what are we doing in terms of our calculations? What we are doing is we are matching deriving our risk, maximum risk per trade. This figure is derived in the currency in which your risk capital is denominated. This is a US dollar figure. Now suppose you are trading Japanese yen here. This is the same kind of example. Like the example that Siddharth had given also. If you look at the Siddharth example. Now, Fidelity in Boston has got a risk capital calculation of $8,000 per trade. Okay, they're doing that kind of calculation. Then they're coming to India and trading in Indian equities. So the P&L in Indian equities is going to be this P&L per unit. This is a rupee P&L. Okay, so they should not be comparing the dollar max risk, but now what they're going to do is they're going to set the maximum loss. They're going to sell the loss per trade equal to the maximum risk per trade. But if this is the dollar figure, this is a rupee figure, they can't compare these two, right? So they have to convert the P&L, projected P&L, into the same currency as the risk capital currency. Okay, so this is all that we are doing here. It's not a very complicated thing. That's what we are doing. So up until here, this one is the P&L in the terms asset, but that's not good enough for us because P&L is in a currency or asset different from asset risk capital amount, risk capital currency. Okay, okay, so we can call this P&L currency. So P&L currency is different from risk cap currency. So therefore, we have to always, so we can write this as one more calculation. Okay, set P&L is trade P&L is the maximum trade P&L. Okay, another principle, general principle is that so for currency is normally written like this, okay, short form. Everyone understands what I mean by risk capital currency. That is the currency, instead of using a big expression, the proper expression, risk capital currency is the currency in which your risk capital is denominated. Okay, so the example we discussed here, the currency, the risk capital is in US dollars, but Fidelity Boston is trading in Indian rupees, in Indian stocks. So the P&L is being generated in Indian rupees. When you trade Maruti, shares of Maruti, whatever P&L you make, that is in Indian rupees. So this has to be converted for calculation purposes, for position sizing, when you're doing this whole exercise, you have to convert the P&L from the terms asset into a currency unit, which is the same as the currency in which the risk capital figure is given to you. Okay, based on your circumstances. That's all we are saying. All right. So far, everyone's following. Remember, you have to ask questions when you don't understand. Otherwise, you may get confused. Although this is not very complicated stuff, but it looks complicated visually also because we're writing the equations in a funny way on Google Docs. So it looks a little. So you have to just pay attention and be clear about if you remember the basic principles, you will never get lost. It may take you a little time, but you will never get lost. Okay. So we can. I just want to remove the underlining here. And right. So for this kind of exercise, trade P&L must always be converted to risk capital currency. So that not be it. All right. So this is the third principle that we have, which we have to always follow. All right, so we have to always convert this. So that's what we're doing here in scenario 1. What we have is, notice that the risk capital currency is different from the P&L currency. But the risk cap currency is the base asset. This is the important part. Okay. So these are the 3 important parts. So now what we do is, this part is the P&L and the terms asset, right? So what we have is this. So we have this, now we bring this back. So this P&L that we generate, this is in Canadian dollars. Can we talk about Canadian dollars here? We talk about Canadian dollars, dollar Canada market. Position will be given in US dollars. We're always trading in base asset units. Okay, that is a market convention. You can ask for a price with a terms asset unit, but that's very unusual. So we are not discussing that scenario. So we are assuming that we write this also as an assumption. Okay. Let's punch it up a little bit. And actually, yeah, this is actually our understood. This is we can actually make it. This is the principle actually, and this is the topic. We have said it like this. Okay. So all trading is done in units of base asset. We are making all these assumptions. Okay, and we are doing the first scenario where, so it's very simple actually when you think about it. So this actually, what is happening, this part of the expression, I mean dollar Canada, this is in Canadian dollars, but that's not good enough for us. We have to convert the Canadian dollars back into US dollars because we want to be able to, because what is the principle saying here? Set the trade P&L equal to maximum risk per trade, and trade P&L has to be converted to risk capital currency. Okay, so therefore, all right. So therefore, we have to convert back this trade P&L into Canadian dollars. Okay. So remember here, this will be, if you do some practice, you'll understand this a little better. Initially, may look a little confusing. So here, if you see, if you go back to, we have a couple of new sheets in your, we have one new sheet in your trade P&L, okay, which is, see this, okay, so this is a 1 million Canadian dollar trade. We're talking about 134 entry. And So this is a short position. So short positions have to be written with a minus sign. Remember, in this kind of formula, you have to write the short position with a minus sign. Okay, so here entering, you're going short at 134 and exiting at 137.50. So you go short at 134 at 137.50. You stop yourself out. How much do you lose? Here, this loss is, okay, so here I've put the scenario 1 in a different way. Actually, we should put this out in, so actually I've jumbled up the scenarios in my mind. Okay. Okay, let's call it this. We'll call this scenario 2. We'll discuss it first and then we'll come back to scenario 1. Okay, so I'll just call this scenario 2 and then later on I'll write scenario. So I don't have to redo the spreadsheet. That's the only reason. It doesn't matter which one you call which scenario, as long as you understand the 3 scenarios very clearly. Okay, so we'll call this scenario 2. Okay, which is that risk capital is in US dollars, trading is in Canadian dollars, so trade PNL is in Canadian dollars. So I have to convert the Canadian dollars back into US dollars. So this is actually this situation. Okay, if I take these two figures straight away, once again, into this, I sell $1 million. All right, notice this. Now this actually, if you do this, if you see this one, look at this, 35,000. So if I do this trade, Canadian dollars, where I sell 1 million USD, and entering the short position at 134, stopping out at 137.50. So what I lose is here, shown here, 35K. What is this 35K? This is a 350 is here. This is the difference between these two. Okay. The difference is so exit price minus entry price. Okay, so this part of the formula is done here. Exit price minus entry price is part of the formula is done here. So it's put here, and then I just have multiplied the position size by the term in brackets, which is exit minus entry. Okay, so this is what I've done. Okay, I did this first as a separate expression, then the cell is showing this into this. So this figure, actually, this figure 35K, this is a Canadian dollar loss. Okay, please understand this. Okay, because this is in the very basic term, like this, where I have removed this. Forget about this. So far, that 35K that you see here in this cell, okay, that is actually only this part. Okay, so projected PNL for this transaction, okay, is, most of these are projections. You're planning, okay, you're planning your losses and you're planning your position size. So it's all projected. But you can control this because you can decide when to enter and you can decide when to exit and you can decide the position size. So this is pretty much under your control. There may be some slippage in the exit price in the sense that you may have a stop at 37.50, but when it actually gets executed, because it will be a market order, once the stop trigger level is traded, then system releases a market order. So your actual execution may be instead of 137.50, it may end up being 137.70, let's say. So there'll be some slippage, but that's okay. We'll assume here there's no slippage. Okay. So, or you factor in the slippage in the exit price. Okay. So that's how you do it in the real world. But in the very, very liquid markets, generally there is very little slippage. So this part is given here, 35K, scenario 2. Okay. But actually, what is the actual loss here? Can anyone tell me in this situation? Not actual loss, means the loss in risk capital currency, because this is the loss in terms currency. Okay. So to find out the loss in the risk capital currency, what should I do? I should divide or multiply. Remember what we are trying to do here. Try to follow the logic, okay? Remember what we are trying to do here. We derive this, we are trading dollar Canada. Terms asset is Canadian dollars. Base asset US dollars. The principle is we have to, PNL is always in terms asset. You know, raw PNL is always in terms asset. But the other principle is telling us that we have to convert the trade PNL to risk capital currency. Okay, so we know trading P&L is always in the terms asset. Okay, then okay, trading P&L is always in the terms asset, but trade P&L must be, yeah, we can call this trade P&L.
Sir, we need to convert Canadian dollars into US dollar.
Okay, so for that, what do I have to do to this figure? 35, this is my Canadian dollar P&L. What do I have to do to this figure?
We have to convert it into US dollars, right?
So for that, what mathematical operation should I do?
Mm.
And subtract what?
Sir, we can see that in 1 Canadian dollar.
Sir, we have to multiply, sir.
US,
Says we have to multiply. Multiply by what?
The conversion rate, sir.
What is the conversion rate right now?
Yeah, sir, it depends.
Jaka's voice is audio is not good.
It's 1.33, sir.
Sorry, 1 point?
337.
1.33, whatever it is. Okay, all right, okay. Anybody else? Anybody else has any other point? Okay, let's do that in a situation where you understand.
Sir, shouldn't we divide it?
Okay, who
we
is
should multiply it by 0.75, I think.
Sir, Utsav.
Utsav is saying divided, okay? Divided by what?
Sir, because 1.34 Canadian dollars equal to 1 US dollar.
Okay.
So 35 Canadian dollars should be equal to 35 divided by 1.34.
Yes,
Okay,
sir.
correct, correct.
Then we will get the US dollars.
Okay, correct, but let's be even more correct, okay? Because what is the objective of this calculation here? What are we trying to figure out here? We are trying to figure out that, I mean, what is the other thing that trade P&L will convert? Estimate, we have to estimate P&L in understand the goal here, okay? We have to estimate the P&L in risk cap currency at time of realization, okay, of P&L. This is the goal, okay? The goal is to figure out the P&L in the risk capital currency when at the time of realization of P&L, it's not perfect English here, I'm trying to save the words. It should be at the time of realization of the loss of profit, okay? So estimate the time of realization. So Utsav is correct, we have to divide. But Utsav said 1.34, okay? Now what is 1.34 here? We have a live example here. What am I trying to figure out? Now look at this statement here. Estimate P&L in risk capital currency at the time of realization of the P&L, okay? Now let's say I go short today and my stop is triggered, say, 6 months from now, okay? So what is the time of realization of the P&L? Is it today or is it March of 2021?
March of 2021.
Yeah, so time of realization of the P&L is March of 2021, okay? So what I have to, if I have to follow this rule, so Utsav is correct that we have to divide by the Canadian dollar Canada rate, but the rate should not be the 1.34 because 1.34 is my entry price, okay? So to be correct, what will be the time when my stop is triggered? What will be the rate when my stop is triggered? Obviously somewhere close to this 3.7, 1.3, whatever it is, 137.50, okay? Here, you see this rate? Because when am I going to be stopped? When the market reaches this price? This is where my stop is. So when I'm going to be stopped, when my stop is hit and actually my loss is realized, the market is going to be somewhere near this figure. Is this clear? Right?
Yes, sir.
Okay. So therefore, I have to take the exit price. I have to divide it. So Utsav is correct that we have to divide, but we have to divide by the exit price. because that is the exchange rate that prevails at the time that the P&L is realized. Is this clear?
Yes, sir. Sir, I did not know that we have an exit price. I thought we are booking the profit at 1.34 only.
No, that's okay, fine, no problem. But you always have an exit price. If you're booking a profit, that's exit price with loss.
Yes, sir. Yes, sir. Then it will be 1.37.
Yeah. So if you're booking a profit, then it is exit price with profit, that is 6.1. Okay. So that's a different one. But exit price with loss is a different calculation. But we are right now concerned with position size. So for position sizing, we really concern ourselves with this one, not with this. We are not concerned with profits. We are concerned with losses, because we want to set our position size in such a way that a loss per trade does not exceed maximum loss per trade. And therefore, and the goal of that is that on any transaction, the loss realized should not be more than the maximum risk per trade, and that will help us to stay within the limit or obey the rule that total loss in any period must not exceed the risk capital amount allocated for that period. Okay, so if you have 750K risk capital for next quarter, you should not realize losses more than 750K per quarter. And the way you make it happen is by tightening it down to per trade. So if you don't break this guideline, then you will not break this guideline either. So that's the goal, okay? So we are concerned because in position sizing, that's how we do the position sizing. We make sure that this is not busted on any particular trade. Okay, coming back to this trade P&L sheet. This is in your second sheet, trade P&L, where we are doing this scenario 2, okay? So we can write this here. Where did we write this? Okay. All right. So what we're doing in scenario 2 is we are trading in USD CAD. Okay. Scenario is USD. Okay. So this we can treat this as USD CAD. Okay. Right. So what we have to do is we have this currency amount. This is actually the P&L in the terms currency, in the terms asset. That's not good enough for us because we want the P&L in the risk cap currency. So we have to convert this to the risk cap currency. And the way we do that is by, as you can see here, we are taking the P&L in the terms asset, dividing that by the exit price, okay? And the reason we divide it is because, remember what we said here in this scenario number 2, because the P&L currency and the risk cap currency is the base asset, okay? So the risk cap currency is the base asset in the particular market which you're trading. So because the risk cap currency is the base asset, which means any rate that you look at, 34, 31, 34, 137, these are all examples of, because the risk cap currency is the base asset. So this is 1 unit of base asset is equal to so many units of terms asset, so many units of terms asset. So when you want to, when this is the situation, when you want to convert a figure in terms asset into a figure in the risk cap currency, which a figure in the base asset, which is the risk cap currency, you have to obviously divide, okay? Again, if these things, if you forget, you can do your simple dollar rupee calculations, which everybody is familiar with, okay? So you have, let's say, if you have some amount in, say, 25,300 rupees, 350 rupees, you want to know what is it in US dollars, what do? You check the dollar rupee rate from the market and you divide the rupee amount by the dollar amount. You can do this in algebraic terms also. You write it down, you'll understand. This means INR this is actually INR by rupees, okay? This is actually INR per US dollars, okay? So therefore you divide it and you get the dollar amount, okay? So you can, I can leave it here actually. There are just a simple calculation which we are doing. All right. So this is the first rule. Okay. So now you understood this first transaction. Okay. The scenario 2, which we did first. What we are writing is this. Okay. I hope everybody's clear by now. I'll bring this back. This is the actual formula. Okay. And this is actually this is just the explanation. We can move it to the side and make it a little, okay, fine, size can remain same. Okay, but this is not good enough for us because we have to bring we have already done this once before. I don't know why I spent so much time on it today, but anyway, I think we learned something. We went into the details of the logic. So now what we want is, this is not good enough for us because we need to find this figure. Okay, this, we are trying to figure out what the position size should be. Okay, this is not the unknown. The unknown here is this. So there's one equation. Notice there's one equation and one unknown. Okay, the unknown here is position size because we are trying to figure out this, how many units to buy or sell. We're trying to model the position size. Go back to your formulation. We are trying to model the position size as a function of maximum risk per trade, entry and exit. Okay, and what is the maximum risk per trade here? This. The projected trade P&L is going to be set as our maximum risk per trade. Okay, so we can already project the trade P&L if we do this kind of entry, and this is our position. This is actually the unknown. So we have to just transpose and get to a situation where we have, which we already did yesterday. We did this calculation yesterday. I think we did it for scenario 1 actually, right? So we did this for scenario 1. We can just do it here. So this will be basically, if you write this, now position therefore will be, so we can just write it as position is equal to P&L. I'll just copy it. So type it. The position will be equal to P&L divided by, okay. Now we have to be a little careful here. Okay, 1 minute. Now this is where in your previous batch also I made a mistake once in the formula because we're not used to doing maths like this and we end up making mistakes. So you guys should check what I'm doing, okay? So here position, well, 1 sec. So what we can do is we can write this as P&L into, let's write it for everybody's ease of reference, okay? So, or we can write, this so that nobody gets confused. This can be a little confusing. So we can write this as this, okay? We take the RHS to the LHS, except for the divisor of the RHS, and we take this as this into exit price, okay? Please make sure that I'm not making any mistakes. So please check what I'm doing. Right? I should not wipe it from there. This should be okay. Is this correct now? Just cross multiply here. Exit price into P&L is equal to position into this, the RHS. Remove the exit, the divisor of the RHS. Okay. So we can write it like this. Okay, which means now we can say this, or we can write. We'll write the or here so that we don't lose a line. Okay. All right. Okay. So we write this is actually okay. So we write this, and we are trying to find out position. So therefore, we can write position is equal to and this is not going to look funny. No, the bracket sequence is the second bracket is coming after the third bracket. So just ignore that. Okay, I'm just using them as different brackets. Okay, I'm just using them as different brackets. Okay, so All right, so PNL into exit price divided by, so the bracketing conventions are a little bit all over the place, so don't mind that. Is this correct, guys? Guys and girls, of course, these days we just use guys to refer to everybody. Maybe we should now start changing that convention. Just say girls and refer it. Use that to refer to everybody because we have used the guys convention for a long time. So yes, is this correct? I think it's correct. I haven't made any mistakes. So position can be written as PNL, the RHS. All I've done is taken the RHS, okay? And because this is A into B product, this can be put in brackets also if you want. Okay, and in that case, there has to be another bracket here, okay? So all I've done is RHS, and this is LHS's position into A, expression A. So position is equal to RHS divided by A. Okay, that's clear. That's fine. So now what you have learned is you have learned a algebraic derivation of position size. Okay, we can do this here. We can what we'll do is we'll just we are just modeling I'll just duplicate this here. And in each of these cases, we'll define the position size. Let's call it number of units. Okay, this is our trade P&L sheet, and now we have number of units sheet. Okay, so here we will have. We'll wipe out all this stuff. We don't need it here. Okay. So what we'll do is we'll just to the right of this, we will calculate the position size, and maybe we can have. Slightly slower. Okay. So what we do is we're just going to apply this formula. Okay. Everybody check this. Just make sure there's no error. I don't think there's any error. Okay. So position should be equal. So let's write it like this. Okay. Trade P&L divided. We're going to write. We'll write one expression for exit price minus entry price, which we already have over here. Okay. We already have this. This is exit price minus entry price. Okay. We have this. Okay. So. Maybe we can do some labeling here so that we don't get confused. Okay, this is what it is. Okay. This labeling, so this I'm keeping as, maybe we can reduce the font a little bit. Don't have to keep it so big. That will help us to fit things in. Can you guys still see if the font is so small? Can you guys still see the numbers? Yes?
Yes, sir.
Okay, okay, good.
Yes, sir.
Yeah, okay. So we'll just use a little labeling and to make sure that we have understood so that we make sure that we understand everything. What is what? This is okay. So this part is our exit price minus entry price. So and then the P&L, the trade P&L is this is the trade P&L. Remember when we talk about this, when we are doing this kind of modeling, what is this principle that is here? Trade P&L must be always converted to risk capital currencies. So two things: trade P&L is equal to maximum risk per trade. And trade P&L, this will come later actually, but this is trade P&L must be converted to risk capital currency, okay, which is what we are doing here when we did this last part. This was only the terms currency P&L, but then we divided by the exchange rate at the time of exit. which is at the time that the P&L will be realized. Divide by that. Why divide? Because in this scenario, other scenarios will be different. In this scenario, the risk cap currency is the base asset. So we divide by it. Okay. So we are going to do that now. Okay. So we are going to take the P&L, the trade P&L that we are going to trade for the purposes of this equation. That trade P&L has to be the trade P&L in the risk cap currency. Okay. So which is what is already there, as you can see here. So we're going to take this here. This is the trade P&L, and maybe we can just copy the text from here. This will have to be put in really small font, otherwise it won't fit. Okay, P&L in. Take this. I'm not going to write. I'm going to write R cap. Okay, so I cap will be invested capital, and R cap will be risk capital. Okay, that much I think everybody can follow. P&L, R cap currency means risk capital currency. Now it's a little easier. So this is P&L and R cap currency. We can actually write it here. All right. So this is a P&L and R cap currency. So we are showing you how we are going from modeling the trade P&L to eventually modeling because ultimately our goal is to model the position size, not the trade P&L. So we model the position size. First we model the trade P&L, then we write it in trade P&L in risk capital currency, and then we flip it around here a little bit. This is actually one equation and one unknown, so we can derive the position size from here. So what we have to do, P&L, this P&L is fine, into the exit price. Okay, so now we can write the formula for position size. We have to just remember this here. So this is what we have to remember. Okay, this is our final derivation. So we have one expression, exit price minus entry price, and the numerator is P&L into exit price. Okay, so we can write another one here. Let's write it for this one. Okay, this expression, P&L into exit price. So here what do you do? Where is the P&L? P&L is here, and where is the exit price? Exit price with loss here. Okay, is this clear, guys? We got this P&L into exit price. How did this happen? One second. Same as P&L is coming out as same as P&L. One second. Okay, yeah. It will be the same as the P&L, yeah, because we are just flipping it back. Okay, here. Okay, so P&L into exit price divided by exit minus entry. Okay. Exit minus entry is this. Okay, so our final answer should be, we can put a row above. Our final answer should be, okay, I'll just take 2 minutes and I'll just finish this one and we'll just cross check it. Okay, so the final answer should be, we'll put it here. The position size should be, the final answer should be what it should be. What should it be? Exit by, that will be the divisor. P&L into exit price, that will be the numerator. Okay. So P&L into exit price. So the final answer should be, this is the numerator and exit minus entry is the denominator. Is that correct? That should be it. Simple. Here. P&L into exit price and exit minus entry. Okay, P&L into exit price, P&L into exit price divided by exit minus entry. All right. Okay, so let's check that, guys. Let's just quickly check that and get that right. Okay. So is it correct? We are getting the same answer. Okay, you can cross check now. We can cross check, so we can actually take the we can call this the from here we can call this the ideal position. Okay. Okay, because actually when you start, the point is when you start, I put in minus $1 million and became $1 million. You don't actually know this. Okay, this is just a random shot I took, but you don't actually know this. What you know is the entry price, you know the exit price, and you know what is the maximum PNL that you can afford to have on this transaction. You know this, okay, which comes from your maximum dollar risk per trade. So when you factor these in, you can get this answer as the ideal position size, and that's your output. Okay, is everyone clear? Please go back and revise. Put us slightly less. Yeah, please go back and revise and understand this. Otherwise, it will not be clear. Okay, and then we'll continue in the next session. Okay. All right. So there should be a change now in the next session. Is that correct? What's up? Now the next session, there's that change which Manik had wanted, right?
Yes, sir. Yes, sir. But
Okay.
when
He has sent that email today. I haven't seen it, but I think Soma ma'am will approve it, and then accordingly we'll have a change next few sessions, next 2 sessions according to the that new schedule. Okay, see you guys then. So class is dismissed. So anybody has a question can stay, others can go, others can leave.
Yes, sir.
Okay.
Sir, on the just a second.
Yes.
Like on a similar question, like if foreign traders convert their currency for trading in another market, so they would have to convert their currency 2 times. So wouldn't it cost a lot to them? And like for India and like every other country wants foreign currency for them. So
No, by 2
uh,
times, let's be clear about what you mean by 2 times. You mean once when they invest and once when they divest.
yes, sir. Yes, sir.
Yeah.
Once when they liquidate and take over.
Yeah, that's just life. That's just life. It's the same as when you go to Europe for a holiday. You have to buy some euros, cash euros maybe, or you can buy some traveler's checks, Euro traveler's checks, and then you go there to Europe and then you don't spend all the money. Then you come back, and what are you going to do with euros in India? You have to sell it back to the bank.
and sir, there is a difference between the rate now in the buying rate and the selling rate as well.
That's the same as the bid and offer difference that you see on the screen when you trade.
Oh, okay, sir.
But sir, like speaking in economic terms, like India wants this foreign exchange, right? They want dollars.
Yeah.
So and they welcome foreign investors, and they want the foreign investors to invest in Indian equities. So is there any relaxation for that, or they have to bear this cost for converting the currency 2 times?
Yeah, there is no, for this particular type of transaction, there is no no real sort of flexibility or benefit or discount given by the government. The government usually tends to operate by giving you special tax rates, maybe for certain sectors. Like they might say that if you invest in infrastructure in a 10-year project, then you might get some special tax rate of 10% or something like that. So they will typically give. So normally the government policies are not focused on giving transactional advantages for investments, conversion of currency at special rates. So that is normally not the focus. They tend to focus on giving concessional tax rates or some kind of deregulation, like IKEA wanted to come in. They have some domestic content requirements. 30% of volume has to be sourced locally. So 30% of your input cost or something like that. So they may relax that and make it okay. We'll make it only 10%, and those kinds of so the government incentives tend to be focused on those kinds of areas, not so much on what dollar rupee rate are you going to get when you pump in the money, and what are you going to get when you take out the money. That is normally they just pay the market rate. Does that
Okay, sir.
answer that?
Yes, sir. Yes, sir. And sir, one more question. Sir, how is the trading of like dollars, USD INR related to the demand, change in demand of commodities, and also how interest rates affect the demand for this foreign exchange of gold, USD INR?
So that is actually very difficult to say, even in the case, let's take the interest rates first. The interest rates actually very difficult to say for sure. It could actually go either way according to economic theory. It depends on why the interest rate is changing. So if you look at the determination of interest rates, there are various factors that go into the determination of, let's say, we look at either, euro currency deposits, but in India, we don't have those. Then in that case, we look at the government bond yields. So you have to go into the decomposition of the government bond yield. So the short answer to that is that there is, for interest rates at least, there is never going to be a clear-cut answer. I mean, actually in economics itself, you can think of two different scenarios which are actually opposed to each other. One is a benefit, one is a positive, one is a negative. And it's really impossible to know which is actually applicable in the market at a point of time. So this is one of the reasons why I don't like fundamental analysis, because it is not very, especially in things like currencies and stuff. I like fundamentals in the case of, corporate debt. When you're looking at corporate debt, I think their fundamental FA has a lot of role to play. Even in the case of equities, I think it has some role to play. But in the case of currency, it's almost useless because the theory is not very clear, and the markets are very, very, they can have huge moves without any change in fundamentals. So it's useless basically. So interest rates can go either way. So we can have that discussion. It's a long discussion actually. You have to go into all the economic theory. You have to go into the composition of the interest rate, government bond yield. Okay, so we'll have some of those discussions on government bond yield in IFM when we do IFM. Okay, so but it's a long answer essentially. But you will not get clarity on that because the theory itself is not clear. It can go either way. And typically you look at bond yield differentials, okay, and the theory is not very clear. So yeah, so the answer to your question is first is that it'll be a long answer. We can discuss the theory. That will take a very long time, several sessions, and even then you will not have any clarity. So it's impossible to form a clear-cut model. Does that answer your question?
Yes, sir. Actually, I was reading and I was trying to make up a summary for the changes in gold prices. So what I read on Mint was like the changes in interest rates. Interest rates are close to zero for US markets, and the investors will look for different opportunities like gold to invest in for appreciating their wealth. But it didn't seem very definitive, and it seemed very, very subjective. Like only interest rate shouldn't have all this effect on the demand for gold.
That's
So
true.
I thought.
And when you asked the question, the second factor you mentioned was interest rate. What was the first factor you mentioned?
Sir, commodities.
Commodity.
Are they interlinked? And like if the price for dollar changes, are there changes in demand for commodities also?
Yeah, see, one is the short answer to that, one mechanical answer to that first part of the question is regarding gold. Is if you look at this, if you see gold, okay, let's look at the CFD price. So if you look at gold, what is happening is that here in this case, what is the terms asset?
Dollars.
US dollars. And what is the base asset?
Gold. Some lot of gold.
Gold. Okay, so yeah, some lot of gold. One troy ounce of gold. Okay, and this is dollars is the troy. So in this case, when you look at, you can read all these things in your chart. I've given you notes on charts right at the end of the set of notes, okay, which I told you to read. If you follow the notes on time series charts, one of the things you can easily figure out, when the chart is going up, that means the base asset is appreciating and the terms asset is depreciating. And the reverse is true for downside, okay. So these are, you can figure it out logically. And the chart is going up, base asset is appreciating. Why? Because here, you could buy one, base asset here is gold. You could buy gold with 1450, 1 troy ounce with $1450. But now here you $2,070 to buy 1 ounce of gold. Okay, so the base asset has appreciated. Gold has appreciated. It used to cost only $1,450. Now it's costing over $2,000. So simple rule is, when the chart is going up, base asset is appreciating. And obviously, if base asset is appreciating, means terms asset is depreciating. Okay, so now coming back to your question about relationship between US dollars and commodities. One statement you can make in a very definitive way is that when commodities in general are appreciating, that ceteris paribus, you remember ceteris paribus from economics?
Everything remains the same.
Correct. All other things remaining
The same.
So if you have to apply that caveat, okay, ceteris paribus, one thing you can definitely say is a mechanical statement, because most international commodities are priced in US dollars. Okay, steel, copper, gold, oil, okay, zinc, aluminium, everything. So because the US dollar is the international currency. So one of the statements you can make mechanically is, when if you see a trend where all commodities are appreciating, in that case you can definitely say that ceteris paribus, that is dollar negative, because that is by tautologically, if commodities are appreciating and they're priced in US dollars, which means terms asset is US dollars. So when gold is appreciating, the US dollar is depreciating. It's mechanical. Okay, it's mechanical. So if we have, it's like if we have a room where where Siddharth and Utsav are sharing the room, but the rule is both of them cannot be in the room at the same time. So if I see Utsav is in the room, then I can conclude that Siddharth is not in the room. It's mechanical. So we can say that if gold is going up, the US dollar is depreciating. Okay, but other than that, you can't now make any more definitive statements. Okay, it's the same thing that you read on Mint and all that. The stuff. Most of the stuff you hear in the markets, most of the chatter that you hear on the TV and all that, is those are all subjective statements. Actually, nobody knows why the market moves the way it does. People talk as if they know, but nobody actually knows. Okay, so in the sense that we know that the water is boiling because we applied heat to the beaker and raised its temperature to 100 Celsius, that's why the water is boiling, and there is no other reason for it. In that sense, we don't know anything at all about the markets. Okay, that is one of the reasons why I'm also very careful about using fundamentals, because it requires certain assumptions to be true, that the market is rational and the market is moving for a certain reason, but actually we don't have any evidence of that. Okay, there's absolutely no evidence of that in a hardcore sense. So these statements, you're correct. These are subjective statements. People talk because they need to sound knowledgeable. Okay, so if we call you on TV, Siddharth Gupta, Mr. Siddharth, why are you going up? If Siddharth comes and says, I was told by my teacher that we really don't know why things are going up, people say, no, Siddharth, you're not a very smart guy. But you have to sound it. Okay, so you have to. Gold is going up because I think, there's a lot of fear in the market and people are afraid of inflation and interest rates are going down and this and that. You have to talk all kinds of, garbage so that people will think, okay, wow, this guy really knows his stuff. So that's a lot of the reasons why people talk. But actually, nobody really knows why the market moves the way it does. But nobody's going to actually come on TV and say that.
Yes, sir.
But you should understand that. Otherwise, you may make mistakes when you're running positions. You should understand that very clearly, that no one really knows why it moves the way it does. But one of the things that very clear is that this is one of the reasons I like technical. Very, very objective. Okay. One of the reasons I like technicals. If you were trading technicals, if you were long using this, whatever this, I think this is frozen. If you were long, Sachin went long FCX because he was a momentum trader. He thought there's an uptrend going on. But the moment that this trend, the support is broken, it is very clear to him that his assumption about an uptrend is now destroyed. So he should be out of the position. So it's very clear cut. And it does not require us, there's nothing subjective here. Sachin can see it and I can also see it. If I knew that he had gone long and he had told me why he had gone long, now when this breaks, I also know that by now Sachin should be out of his position. So it's objective. So this is one of the reasons I like technicals, because what happens is you do certain things based on certain assumptions, and you can see immediately, you can see in the market price whether your assumption is broken or not. And if you're disciplined, when your assumption is destroyed, you should get out. So it's very cut and dried, and it's very, very precise and very objective. So it's one of the reasons I like technicals, actually, because there is less fluffy stuff going on.
Yes, sir.
Okay. All right. Any other
Yes,
questions?
sir. No, sir. Thank
Sir,
you.
in that calculation file, I'm not clear about that one in the blue box. I think I missed this point. -1. Yes, sir.
One. No, this is just to save me the work of writing millions every time. So this one is basically 1 into 1 million.
Okay.
So if I write this as -7, then it will become 7 million.
Oh, okay, okay, sir. That is just the position we want to be.
It's just a shortcut for me, actually.
Okay, sir. Okay, sir.
7 million every time. So I'll write -7 and it will become 7 million.
Okay, sir.
All right. So we'll keep it as -1. All right. Okay. So please practice this. Okay. We'll talk. We'll meet in the next session. Okay.
Thank you, sir.
Okay.
Thank you, sir.
All right.